Hello, and welcome to the Argus Way to Freight podcast, where we explore the powerful connections between freight and the commodity markets. Today, we're going to be talking about the geopolitical situation in the Suez Canal and how that is affecting European clean freight and diesel markets. With me today are clean freight market reporter Erika Tsirikou. Hi, Erika.
Hi, John.
And I also have with us oil products market reporter Josh Michalowski. Hi, Josh.
Hi, John.
Right, so let's start off with you, Erika. How has the Suez Canal situation been looking from a freight perspective?
So traffic through the Suez Canal initially seemed like it could pick up significantly in 2026, right after the Yemen-based Houthis announced the suspension of maritime attacks in the Red Sea. Danish shipping firm Maersk announced the switching of its MESL route, which runs between the Middle East and the US Atlantic coast, back to the Suez Canal full-time after two successful transits from its fleet at the end of 2025. At the same time, container ship owner CMA CGM has sent two container carriers through the Red Sea and Suez Canal as a test, but it ultimately extended the routing of three of its key services via the Cape of Good Hope still, as did Mediterranean Shipping and Evergreen. The Houthis released a short video a week ago on an officially linked channel showing a navigation chart of the Bab el-Mandeb Strait and the single word soon in Arabic. Even though they have not yet made any official statements that they will resume attacks in the region, uncertainty has spread in the market again, especially after Maersk returned to the Suez Canal a few days prior to the event.
Fascinating. So it really feels that for the first few weeks of January, everything has been on track for a major return, but a lot of the situation in the Middle East is creating some uncertainty there. Would you agree?
Yeah, certainly. It was looking like a return to the Suez Canal was looking very real until last week, but as we can all understand, it is very uncertain at the moment. So we cannot tell whether a full return to the Suez Canal will actually take place in 2026, as it might have seemed, as tensions in the region have escalated again, and participants prefer to take a wait-and-see approach for the moment to see how the situation will unfold. In general, charterers will struggle to mandate a vessel to transit the Bab el-Mandeb Strait because the area is still rated at risk by the Joint War Committee. In such a case, the charter will probably have to cover the additional war risk premium payments subjective to the charter party at hand, which could be significant.
So those additional risk premiums, those are really key to the Suez Canal and have been over the last couple of years. It was those payments that first really pushed the freight market away from the Suez Canal as a result of the Houthi attacks, when they rose as a result of the Houthi attacks, and moved them around the Cape of Good Hope. So do they remain a significant issue, or have the war risk premiums or AWRP dropped?
So AWRP rates have indeed dropped to 0.3 to 0.6% of a vessel's hull and machinery value, down from where they used to be at around 0.7% before the ceasefire agreement. And as we can understand, if the Houthi ceasefire holds, these levels will likely drop further. But they still remain a major concern for ship owners at the moment because they increase the overall cost of going through the Suez Canal. So the economic default will continue to be the Cape of Good Hope route for ship owners until risk premiums and canal costs altogether are ultimately lower than the fuel cost of going through the Cape of Good Hope route. In general, ship owners want to keep their vessels tied up for longer voyages because that implies fewer ships available at any one time in the market, higher spot rates, and stronger earnings as a result. So apart from the security risks, the economic benefit of going via the Cape of Good Hope route is still keeping most ship owners from returning to the Suez Canal.
Interesting. Now, turning to you, Josh, we've seen that it looked like we were on course for a full-fledged return, but we are currently seeing some disruptions, certainly around the Mideast Gulf situation. But assuming that we are going to start to see more of a return and we are going to see some more diesel volumes coming to Europe from the Mideast Gulf through the Suez Canal, how would this affect the European distillates market?
I think the first thing to mention is that the European diesel market last year was really supply driven. Now, the demand picture in Europe is very poor, whereas supply side shocks caused price spikes last year. Cracks reached actually over $40 a barrel in November because of these supply side shocks. And that's because imports into Europe take much longer than they used to when Europe had access to Russian barrels. You're looking at around 6 weeks around the Cape, 4 weeks through Suez for imports from the Mideast Gulf. If we did see a full return to the Suez, the journey time towards Europe for those imports is that little bit less, meaning that traders can react a bit quicker to supply side disruption, therefore theoretically keeping prices lower and more stable. It is worth mentioning also, you could see a redirection of Saudi flows. Most Saudi exports towards Europe come from the Red Sea. If the Suez becomes more viable, i.e. passing through the Bab el-Mandeb Strait, you might see some more product coming from Saudi refineries in the Mideast Gulf towards Europe as well.
Will this affect the dynamic for Europe with regards to other suppliers? Europe gets quite a lot of its diesel from the US. Do you think that traveling through the Suez would make the Mideast Gulf an even more attractive source of origin, even though it is already one of the most attractive?
I think potentially, yes. It's worth mentioning that, the Mideast Gulf, it's more orientated towards the Mediterranean, whereas the US is more orientated towards Northwest Europe. And the journey from the US is actually only 2 weeks-ish. So you could see maybe a slight kind of shift towards more exports from the Mideast Gulf towards Europe. I wouldn't say it would totally dominate the US. It's also worth mentioning the sanctions picture, but I think we'll dip into that a bit more later on.
Perfect. So, Erika, seeing that there is this possibility of increased shipments through the Suez, what kind of impact is this going to have on tanker rates, and what impact is it already having on tanker rates?
So we cannot yet tell how the situation will affect the LR markets yet, but when tensions last escalated in June, LR rates climbed by 25%. But it's worth noting that the clean segment was slower to respond to the situation than the crude one because of limited demand for Mideast Gulf diesel back then. There is a number of contradicting factors that are affecting the LR segments at the moment, which could have opposite effects on freight rates. First of all, Europe's recent ban on imports of products refined from Russian crude, along with other US and EU measures, have cut exports from India and Turkey, which are both major buyers of Russian crude and diesel. This shift in supply is likely to support Mideast Gulf LR rates on both the westbound and eastbound routes, as the Mideast Gulf will be reinforced as the region's sole or primary diesel supplier, rather. But a shipping move back to the Suez Canal, as we said, could counterbalance the upward momentum generated by the sanctions, because the average journey for an LR tanker would shrink, and this situation would create a lower ceiling for both LR1 and LR2 rates in 2026. LR rates for Suez Canal crossings currently stand at around 1 to 200,000 more than Cape of Good Hope ones for both LR1 and LR2 tankers.
Fascinating. So the Suez is currently pricing at a premium to the Cape of Good Hope, whereas traditionally it would price at a fairly significant discount. Do you see the current premium shrinking?
Yes, so as you already said, the premium for Cape of Good Hope transits was around 1 million higher than the Suez Canal rate at some point. But I expect that when things normalize, it should drop back to 300,000 or 400,000 lower for a Suez Canal transit compared to the Cape of Good Hope transit.
Interesting. Turning to you now, Josh, you mentioned the EU sanctions earlier. Those have been a key factor to start off 2026. So how have these EU sanctions appear to have changed, say, Reliance's flows of diesel through the Red Sea?
Yeah, so to give a bit of context for Reliance's flows last year, they accounted for about 15% of the EU's diesel imports, and about 70% of that volume from Reliance went through the Bab el-Mandeb Strait and then through the Suez Canal. So they were probably the largest player that consistently went through the Bab el-Mandeb Strait in terms of shipping towards Europe. Because of sanctions this month, the general picture is that a lot of that Reliance product has shifted towards West Africa instead, obviously needing to go around the Cape. I think looking forward, it's theoretical that Reliance would shift back towards using the Suez, and that's because they said on 20th December that they'd stopped taking Russian crude into their Jamnagar refinery, which is the refinery that accounts for the vast majority of Indian exports towards Europe. However, in the short term, it's much, much less clear. There are tankers in the Mediterranean with distillates from Reliance, and it's really not clear at the moment, and this on the 2nd of February when we're recording this, it's not clear at the moment whether those tankers have discharged yet in Europe. So I think overall, short term, looks like Reliance distillates are swinging towards West Africa, which suggests Red Sea usage. In the long term, given that they've cut off that Russian crude into Jamnagar, I think we'll probably see a return to using Suez.
Interesting. Well, I think we've covered all the key points, and it appears that, again, the Suez Canal is going to be a key factor moving forward in 2026 and potentially could swing in either direction. It could become a vehicle for trade or equally a barrier. I think that about wraps up everything that we have for today. We've done a good deep dive into both the freight and diesel markets, and I'm sure that we will be back most likely very soon to talk about things more as they evolve. So first, I'd like to thank our guests, Erika. Thank you, Erika. And Josh. Thank you, Josh. And thank you to everyone for tuning in. And if you want to learn more about Argus's clean tanker freight and diesel coverage, then all of the details are available on our website. We hope to see you again in the next Way to Freight podcast. Thank you and goodbye.